Hello, learners. Hi, how are you all? I hope you're all doing good. In fact, great. I'm back with June 2022 CA Foundation examination paper discussion. In the past two parts, what you've seen, past two parts that you've seen, we've discussed question number one, two, three, and first part of four. So in this video, we'll be finishing off the rest of the paper. Question number four, part B, five and six. So let's go ahead and then discuss this. But before we go any further ahead, I'm also here to inform you about the new foundation fast track revision batch that we're starting on Unacademy platform. The batch is Hustle with Yashas. It's the batch from the team of Yashas Academy. It will include Shandar Ahmad sir will handle economics BCK, Nitika ma'am will handle law, Hardik sir will take accounts, Anil sir will take math stats, and Pooja ma'am will be handling PCR. It's already started on 25th of August. The session details are here. Various subjects on starting on various dates. The timing is going to be 3 p.m. to 5:30 in the evening, followed by the second session from 6 o'clock to 8:30. So what are you waiting for? Take up an Academy subscription today and join us live in this journey of CA Foundation. You know the greatest features of our batch. We have India's best educators on the platform, 600 plus hours of live content, recorded backup available, one-to-one doubt solving, one-to-one mentoring. What to say? The best of the material, quizzes at regular intervals. What more do you ask for? If you want to ask for more, you can take up Iconic subscription, which along with this all plus benefits, it will also give you benefits of hard copy of the material coming at your doorstep and doubt solving, which is supposed to be very highly beneficial, and mentorship, which is one to one. So what are you waiting for? Take up subscription today, and the subscription details are here. If you're taking a plus subscription, a 24-month subscription comes at a cost of 24,200. An 18-month subscription is at a cost of 21,000. 12-month subscription is 17,600. 6-month subscription is 13,200, and a 3-month subscription is 11,000. You can also choose Iconic subscription by paying 41,800 for 24 months, 36,000 for 18 months, 29,500 for 12 months, and 21,300 for 6 months. And if you use the code YESHAS, which is YESHAS, you would get 10% off on the prices that you see on the screen here. So please do take up subscription and join us in this journey. Now, let's get back to CA Foundation Principles and Practice of Accounting June 2022 solution discussion. Like I mentioned in the past, we've done question number 1, 2, 3, 4, part A. This is third one. 4 part A is done. 4 part A is regarding NPO. Now we'll discuss 4 part B. Yep, this is the question on partnership. So let's start discussing question number 4B. And the video links to the other videos, part 1 and part 2, is available in the same playlist in which you're watching this YouTube video. So please do watch part 1 and part 2 also alongside with this. Come on, let's start reading the question. X, Y, and Z are partners sharing profits and losses in the ratio 1:2:3. Very good. So this is their profit sharing ratio. Their balance sheet as on 31st of March 2021 is as follows. It's a very small, cute, sweet balance sheet that's down here. And Z retired. Oh, who retired? Z. It's raining heavily when I'm recording this video. There's going to be a little power fluctuation. If one of the light goes off and it'll become a little dark, I might not look fair, but the screen and the answer would still be visible. So don't turn off the video when you do that, when the power goes off. Yep. So Z has retired. Z has retired. Very good. Happy retirement to Z. And they've told he has retired on 1st of April 2021. This balance sheet is on 31st of March 2021. So right after the balance sheet date is when Z is retiring. So they've given certain transactions. These are with regard to revaluation. The first one is on building. So building is appreciated by 25%. So this building here has an adjustment. Then what is the next item? X, Y, and Z to bring additional capital that will come in capital account. And machinery is being depreciated by 10%. So there is revaluation on machinery also. And then what do we have? Then we have stock to be revalued to 3,72,250. So stock has a small revaluation here. This would also appear in revaluation account. And then we have provision for doubtful debts is to be created at 4%. So this debtors, what you see here, also has an adjustment. Oh, almost every other item in the balance sheet asset side has adjustment. And bank though, however, we're preparing account because there is additional capital brought in and retiring partner would have to pay at least some part of his share. So for such transactions, we would open bank account also. So we have 5 accounts to be opened right now. So goodwill computation is given how to compute goodwill. Goodwill was not to be raised in the books of accounts. So basically, we'll adjust goodwill through the capital accounts. The retiring partner has to get his share of goodwill before he retires. So we'll credit retiring partner's capital account and debit the continuing partner's capital account. The gaining partners who gain, they have to sacrifice, they have to give from their capital to the retiring partner. So the entry will be gaining partner's capital account debit to retiring partner's capital account. Done. So then we have balance payable to Z was to be paid immediately. We're paying immediately. So there's no balance carried on in returning partners capital account as such. They want us to prepare revaluation account, bank account, partners capital account after giving effect to Z's retirement. Okay. And show the valuation of goodwill and pass a journal entry for adjustment of goodwill. Let's do it all. So it's a 10 marker. Trust me, this is a lottery question. You should be really happy for a question like this. Simple, sweet, not any difficult adjustment. Come on, let's start. In the books of X, Y, and Z partnership form. In the books of X, Y, and Z partnership form. So question number 4B. We're starting with revaluation account. I'll just drop the format of revaluation, partners capital, bank, and start with the transactions. And have they asked balance sheet? Have they asked balance sheet? Nope, they haven't asked balance sheet, so will not prepare. If it was a regular class, I would have done much more. I would have prepared balance sheet also, though they have not asked. But considering the fact that this is not a regular class, we will not be preparing something that they have not asked. We will not be preparing something that they have not asked. We'll only prepare what they ask. Okay, guys, chalo. So I'll keep my revaluation, bank, and partners capital account open. I'll read the question in the order. Whatever affects, wherever it does affect, I'll just go on posting it. So to start with, I'll just take a green ink and then tick the items that I've posted. We'll start with the capitals X, Y, and Z. 1 lakh 75, 2 lakh 50, 4 lakh. This will go to our capital account. So this is our revaluation. I'll come to partners capital account. And in the partners capital account, on the credit side, I would have to write by balance brought down. How much is X share? 1 lakh 75. Y? 2 lakh 50. And Z? 4 lakh. So 1 lakh 75, 2 lakh 50 and 4 lakh rupees are the capitals. We've just posted it. Then we have general reserve of 3 lakh. This general reserve of 3 lakh has to be divided between X, Y and Z in their partnership ratio. What is a profit sharing ratio? The old profit sharing ratio before Z's retirement. Because that's when the reserve is accumulated. The profit ratio is 1 is to 2 is to 3. So we will share this 3 lakh in the ratio 1 is to 2 is to 3. So 3 lakh into 1 by 6, 3 lakh into 2 by 6, 3 lakh into 3 by 6. So 50, 1 lakh and 1 lakh 50 will be the amounts. This will increase their capital. So in their partner's capital account, I'll write by general reserve. Yeah. 50,000, 1 lakh and 1 lakh 50. How did we get this? This is sharing that 3 lakh in the ratio 1 is to 2 is to 3. So 3 lakh into 1 by 6, 3 lakh into 2 by 6, 3 lakh into 3 by 6. Then what do we have next? We have trade creditors of 2 lakh 50. We are not preparing any balance sheet here, so that would go nowhere. It will just be there because there is no revaluation also of this trade creditors. If it was there, I would have adjusted. Or if I was preparing balance sheet, I would have written this 2 lakh 50 straight to the new balance sheet. So it's neither is the case. Let it be there. Then we have building of rupees 2 lakh 50. So this has an adjustment. If I was preparing balance sheet, I would have written this 2 lakh 50 in the balance sheet on the asset side, but in the inner column. But however, now we are not doing balance sheet. I would just ignore this. How about that adjustment? When I read the adjustment is when I'll adjust. Till then I will not. Then we have machinery, debtors, stock. I will not be affected with these items. They have adjustments. As and when I read adjustment, I'll post it. Right now, these items will not go to partner's capital account or bank account. When there is any adjustment, I read it. I'll put it to revaluation. So I'll wait till then. Then there is bank balance of rupees 62,500. We are opening bank account. So in the bank account, I'll write debit side, to balance brought down 62,500 rupees. Let me just write it on the debit side and then chill. Now let's go down to adjustments. So Z retired on 1st April, good for him. Building to be appreciated by 25%. So existing building value is 2 lakh 50. Now we're going to appreciate it by 25%. So we're going to add it by 25%. So building value as it is increasing, we need to debit building account. Credit will be given to revaluation account. So the entry will be building account debit to revaluation. So what is the entry? Building account debit to revaluation. So in revaluation account, I'll write by building. I'll write by building. So this is to the extent of 2,50,000 into 25%. Let me do that. That's 62,500. So we're going to write 62,500 here. That's the value of the building being appreciated. And in the balance sheet, building whatever we've written in inner column, 2,50,000. To that, I would add 62,500. Done. Then we have machinery, 3,37,500. So machinery has an adjustment. We were reading adjustments. We are just done with the first adjustment. Second adjustment is X and Y to bring in additional capital of 5 lakh each. So let's write the entry for they bringing in 5 lakh each. So 5 lakh will be brought by X, 5 lakh will be brought by Y. Together they bring in 10 lakh rupees. How much do they bring in together? 10 lakh. So the journal entry will be bank account debit to partners capital account. In partners capital account, I'll write by bank for the additional capital that they're bringing in. This is 5 lakh, 5 lakh. And this will come in our bank account on the debit because bank balance is increasing to X capital to Y capital 5 lakh. Then the next entry is machinery to be depreciated by 10%. As the value of the machinery goes down, we need to credit machinery account and debit will be given to revaluation. Entry will be revaluation account debit to machinery. How much is it? It is 10%. 10% of 3,37,500. That is 33,750. 33,750 is the entry revaluation account debit to machinery account 33,750. 33,750. That's the amount. Let me write that there. Then what do we have? Next adjustment. Stock is revalued at 3,72,250. So come down here. Stock is right now at 4 lakh. We need to revalue it to 3,72,250. Chalo, let's do 4 lakh minus 3,72,250. That gives me 27,750 of revaluation. I need to bring the value of my stock down. So stock account has to be credited. Debit will be given to revaluation. Entry is revaluation account debit to stock. So let me write in my revaluation account to stock account 27,750. That is 4 lakh minus 3,72,250. 4 lakh minus 3,72,250. That's the answer. And let's go forward. What do we have after that stock? We have bank balance of 62,500. Bank balance of 62,500. I'll write bank account debit. To balance brought down 62,500. That's done. Oh, sorry. We were reading adjustments, right? So we're done with your fifth adjustment. So the fifth adjustment that we have is provision for doubtful debts is to be created at 4%. So how much is provision for doubtful debts? 4%. And this 4% will be created on what? On debtors of 3,25,000. So we'll do 3,25,000 into 4%. That, my friends, is 13,000. How much is 3,25,000 into 4%? 4% provision to be created. That comes to 13,000 rupees. So this 13,000 of provision, whatever is there, it is decrease in the value of debtors. You get that? So it will come as an expense here. I'll write revaluation account debit to provision for doubtful debts. That 4%, which is 13,000. So it's written on the debit. Let it be there. And this will be deducted from the debtors in the balance sheet asset side. Great. So what do we have after this? Then we have goodwill. Goodwill was to be valued at 3 years purchase of average profits of past 3 years. Profits for the past 3 years is 2,75,000, 2,50,000 and 1,95,000 respectively. Let's do that working note. The working note we have is here goodwill computation. How do we compute goodwill? It is 3 years average profit. So we'll do year 1 profit plus year 2 profit plus year 3 profit divided by 3. So goodwill is equal to all the 3 years profit divided by 3 multiplied by 3 years purchase. So 2,75,000 plus 2,50,000 plus 1,95,000 divided by 3 multiplied by 3. That's basically the sum total. However, let's still find it. Goodwill is equal to 7,20,000. Goodwill is how much? 7,20,000. And this goodwill is earned by all the 3 partners X, Y and Z together with great hard work. Now Z is retiring, so we need to give Z his share. When Z takes his share, it is 3 by 6. It has to be compensated by X and Y in the ratio 1:2. Because there is no other information about ratios in the question, we are assuming that old partners X and Y who are continuing to be partners after Z's retirement will continue to earn in the same ratio. So X and Y, the continuing partners, will gain in the exact same ratio, 1 is to 2. So we'll compute 3 by 6 of the goodwill as Z's share of goodwill what you should take home, and this is to be compensated by X and Y in the ratio 1 is to 2. Let's do that. So have a look. Old profit sharing ratio is equal to gain ratio is equal to 1 is to 2, and X capital is going to decrease. X capital account debit. Y's capital is also going to decrease because they both are gaining in the future. They're giving it to whom? They're giving it to Z. So Z's capital account we need to do 7,20,000 total goodwill into 3 by 6 what is his share, which comes to 3,60,000. X and Y are going to sacrifice their share, which we are going to compute as 7,20,000. No, 3,60,000. Whatever Z is taking in the ratio 1 is to 2. So 3,60,000 by into 1 by 3 and 3,60,000 into 2 by 3. That is a sacrifice, or that is a contribution to be made by X and Y. So it will be 1,20,000 and 2,40,000. So 1,20,000 will go from X capital account, 2,40,000 will go from Y's capital account to Z's capital account, summing the amount up to 3,60,000. So now let me write in Z's capital account credit, it should be 3,60,000. In the Z's capital account for the goodwill adjustment, it should be credit 3,60,000, and in the books of what to say our X and Y, it should be 1,20,000 and 2,40,000. This because I'm writing the amount in X and Y's column, I'll write here 2Z's capital, and this I'll write here by X and Y's capital account. This is for the sake of the goodwill adjustment. I hope you all understood this part. Then goodwill adjustment is over. We've also written the journal entry. This adjustment is done. Goodwill was not raised. Balance payable to Z was paid immediately. So in the Z's capital account, balance and figure will not be balance carried on. Instead, it will be to cash or bank. In this case, we have bank account, so it will be to bank. That's it, guys. We're done with all the adjustments. So what would be the total here that we have? 33,750 plus 27,750 plus 13,000, which comes to 74,500. And here we have 62,500, but we'll write same 74,500. And the balancing figure is revaluation loss, which should be shared to all the partners. Got that? So I'll write by partners capital account loss on revaluation balancing figure, that will be 12,000. It will be shared between all the partners X, Y, and Z in the ratio 1 is to 2 is to 3. So let X, Y, Z. So 1 is to 2 is to 3 ratio mein 12,000 comes to 2,000, 4,000, and 6,000 together coming up to. And this money, whatever is shared loss on revaluation by rating by partners capital account, has to be written in partners capital account as the share of loss that has come. So I'll write here to revaluation account X 2,000, Y 4,000, Z 6,000. Done. So my revaluation account is done. Partners capital account is done. Partners capital account I need to find balance carried now. And Z's capital account whatever balance is there, that will be bank. Yeah. So we have more total here. 1,75,000, 5 lakh plus 50. So that's basically 7,25,000. I'll write 7,25,000 here and then identify the balancing figure as balance carried on in X column. Similarly, I can close my Y column. Y column may 2,50,000 plus 1 lakh is 3,50,000 plus 5 lakh comes to 8,50,000 is the credit total. I'll write it on the debit 8,50,000. We have 2,44,000 here. 2,44,000 minus 8,50,000. 6,06,000 is the balance of Y's capital, which is carried down to the subsequent year. And when you come down to Z's capital account, Z has a credit total of 4 lakh plus 1 lakh 50, 5 lakh 50, 5 lakh 50 plus 3 lakh 60, 5 lakh, 8 lakh 50, 9 lakh 10,000. Correct? And that 9 lakh 10,000 I'll write here. Z is no more our partner, Z is retiring, so I can't write balance carried down, but the entire balance in Z account is paid. 9 lakh 10 minus 6 is 9 lakh 6,000. I'll write 2 bank account, and this, my friends, is balancing figure. Done. And because I'm writing 2 bank here 9 lakh 4, the same has to be written here as by Z's capital account 9 lakh 4. We had 10 lakh 62,500, from which 9 lakh 4,000 is paid to Z, and whatever is left is our balance carried down of 1 lakh 58,500. As the question requires us, We have successfully prepared our revaluation account, partners capital account, bank account, and working note for goodwill, including journal entries. Now, let's move on to question number 5. This looks like a question on final accounts. Let's quickly see what is this question all about. Shall we? The following is the trial balance of Mr. B for the year ended 31st of March 2021. Great. They've given particulars amount, opening stock, raw material, lot of items in the trial balance are given. We'll use all of this. What do they want? There's some additional information also. They're saying you are required to prepare manufacturing, trading, and P&L account and balance sheet as at that date. Fantastic. One big question of 20 marks. This one. It's going to take a while, but let's do it. Yeah, we are not here to back off, and it's very much doable in the examination also, this question. So come on, let's discuss this. So we have information about closing stock here, and we have adjustment on debtors, depreciation on building and machinery. Closing stock, it will come at what is a trading account and balance sheet. We'll make a small marking next to debtors saying that there is adjustment. We have debtors, Sunday debtors. This has adjustment, and there is depreciation on building and machinery. So I'll make a marking next to building and marking next to machinery. Building, building, machinery, debtors. These items have adjustment. So when we post this item to balance sheet, let us write them in the inner column, adjust them and then post the balance to outer column. What do we have after that? Then we have some adjustment on accrued commission and interest. So let's make a small marking next to commission and interest. Commission and interest. Commission is income. Do we have commission anywhere here? No. Is there commission expense here somewhere? Yeah, commission paid expense. It has some adjustment. And is that interest accrued? Interest has accrued on investment. Do we have investments? Okay, this investments where there is interest. And this interest is interest paid. That's not what we're talking about. Commission accrued is commission to be paid. Okay. Then this doesn't have any item in the trial balance to be marked with. Salary there is outstanding and there is prepaid interest. So we'll make a small marking next to salary and next to interest. Perfect. So we made markings to all the items that has adjustment. Now all we need to do is just start doing the problem. Let's start. So opening stock of raw material and finished goods. So we're trying to prepare manufacturing, trading and P&L. Remember the stock variants may raw material and work in progress comes in manufacturing account. Finished goods comes in trading account. So in the manufacturing account, opening and closing will be work in progress, and raw material will be used to compute our consumption of raw material. Done. So let's start with the first item. Opening stock, raw material, finished goods. Let's write both of them in our manufacturing account. Shall we? So as I told you, work in progress will be our starting point. We don't know that. And then we would have to find consumption of raw material, which is found as opening raw material plus purchases minus purchase return. And then that's how we basically find our, and then we'd have to deduct closing. We have to find the closing. So once we find the closing, closing will be deducted. But I don't think we have closing stock mein raw material in this case. Have a look. Closing stock is given as one single item. Finished goods are they only there. Raw material and work in progress. Closing stock is not there. So don't have to deduct. If it is there, I would have deducted. So let me write opening stock plus purchase minus purchase return. And if it was there, I would have deducted my closing. Done. So how much is the opening? 5,25,000 is the opening of raw material. Then you have finished goods 2,62,500. This will come in trading account on the debit side opening. So this is my trading account. On the debit, will write to opening finished goods 2,62,500. Then what do I have? Purchase of raw material 17,50,000. So this purchase of raw material will be used in computation of consumption of raw material. I will write opening of raw material plus purchase minus closing minus purchase return to find consumption. So here I'll write purchase of raw material 17 lakh 50. Done. Then land and building 3 lakh 50. This will come in the balance sheet asset side. Straight away I'll write in the inner column. We'll wait for adjustment of depreciation and then post it out. So land and building is 3 lakh 50. Balance sheet asset side I'll write land and building 3 lakh 50,000 and wait for it to be depreciated, and then I'll write post depreciated value in the outer column. Then we have loose tools 1 lakh 5,000. This will come in the balance sheet asset side again. I'll write loose tools 1 lakh 5,000. There is no adjustment, straight away outer column. Then we have plant and machinery 1 lakh 5,000. This is my asset, will go to balance sheet, but it has adjustment, so I'll write the balance in the inner column. So plant and machinery, I'll write in the inner column 1 lakh 5,000 and wait to write depreciation and then post it to outer column. Then we have investments of 87,500. This will again come in our balance sheet as an asset. I'll write them straight in the outer column 87,500 because there is no adjustments. Done. Then we have cash in hand and cash at bank 70,000 and 17,500. I don't think we have any payments. Are we going to do any payments? No, we are not. So I'll write straight away this balance of 70,500 and 17,500 as assets in the balance sheet. Shall I? Investments, cash in hand, cash at bank. Cash in hand is 70,000. Cash at bank is 17,000. Done. Then we have furnitures and fixtures 52,500. This has no adjustment, so I can straight away push it to outer column. I'll write here furnitures and fixtures 52,500 straight away to outer column without any adjustment. Balance sheet asset side. Bills receivable 52,500 is a current asset. So I'll write below cash in hand and cash at bank. Bills receivable 52,500. It has no adjustment, so I can post it straight to outer column. Then we have sundry debtors of 1,40,000. This has adjustments with regard to provision. I'll write sundry debtors 1,40,000 in the inner column and wait to adjust that bad debts or provision for bad debts, whatever. After adjusting, I would post the balance to outer column. So after 1,40,000, we have drawings of 70,000 rupees. This has to be deducted from capital. So I'll write capital less drawings 70,000. So I don't know how much is my capital. As and when I come to know, I'll write that capital. And after deducting drawings, I'll add the interest on capital, adjust interest on drawings, and net profit, all such items there. Then we have salaries. How much is our salaries? 70,000 rupees. It's an expense, but it has adjustment. So I will write in my P&L account on the debit side salaries and write the amount in the inner column. How much is paid? 70,000 is paid. I'll wait to adjust that accrued salary, outstanding salary, whatever, and then identify the amount to be returned to the outer column. Then we have coal and fuel. Coal and fuel will be usually used in manufacturing. So 52,500 will go to manufacturing account. I'll write them as expenses. Coal and fuel 52,500. Do you guys get that? Then we have factory rents and rates. This is also manufacturing expense of 70,000. It will come in our manufacturing account on the debit side. So let me write in the manufacturing account on the debit side factory rent and rates 70,000. Get that? This factory. Yes. Factory rent and rates done. Then we have general expenses of 14,000. General expenses are incurred generally in nature. So let's not write it in our manufacturing account. Let's write it in P&L account. So I'll write here general expenses 14,000. No adjustment, straight away outer column. Advertisement again is expenditure which is to come in P&L account, indirect expense. I'll write two advertisements 17,500 in P&L. Then we have sales return of 35,000. This sales return of 35,000 should be deducted from our sales. As of now, we don't know how much is our sales. So in my trading account, I'll write by sales. I don't know how much is it. I'll write by sales return and write 35,000. After I find my sales, I'll deduct sales return and then post it to outer column. Then we have bad debts 14,000. This is already deducted from debtors. I don't have to adjust it against debtors. Right now, what I can do with this 14,000 is straight away write it in P&L account debit side. Straight away write it in P&L account debit side. So in my P&L account on the debit, I'll write two bad debts. Amount is 14,000 rupees. Done. Then we have direct wages. These are paid at the factory. Manufacturing expenses of 2,80,000 to be written in manufacturing account on the debit to direct wages factory 2,80,000. Then we have power. This is also expenditure for manufacturing 1,05,000. I'll write it in manufacturing account on the debit to power 1,05,000 rupees. Then we have interest paid 24,500. This interest paid is expense. I'll write in P&L account but not in the outer column because it has adjustment. We'll adjust it and then post the amount outer column. Right now I'll write that what is paid is 24,500. Discount allowed is 10,500. This discount allowed being indirect expense, will write it in P&L account debit 10,500 without any adjustments to the outer column. Carriage inwards is direct expense. Carriage outwards is indirect expense. Carriage inwards 52,500. I'll write it in my manufacturing account. Let me write in manufacturing account here. Sir, can this be an expense in our what do you say trading account? Yes, it can be. But because we're preparing manufacturing, I'm assuming that this expenditure is in manufacturing account. Carriage inwards, how much is it? It comes to 52,500. I've written it here. After carriage inwards, we have carriage outwards 24,500. This carriage outwards will come in P&L account. I'll write here to carriage outwards 52,000, sorry, 24,500. Then we have commission paid of 17,500, which is expense indirect in nature, P&L account debit. I'll write commission paid 17,500. I'll wait to adjust the outstanding or accrued whatever given and then write the amount of column. Right now it will stay in inner column. Dividend paid is expense which is 14,000 and we cannot say that this dividend paid is manufacturing or trading expense. In fact, it should be called as an appropriation item and then written in balance sheet. For now, we'll write in P&L account. To dividend paid is 14,000. Then let's go to the credit side. I'm writing it in P&L account because we are not preparing P&L appropriation. Otherwise, you can write this as amount paid in our what do you say reserves only. We can deduct it from reserves. Sundry creditors 1,75,000. This will come in balance sheet liability side. I'll write here sundry creditors. How much is it? 1,75,000. Then we have purchase return of 17,500. This will be deducted from our purchases. Purchases of what? We are not purchasing finished goods here to deduct it from our trading account purchases. We are purchasing raw material which is later converted to finished goods. So I'll deduct this purchase return also from raw material. I'll write purchase return of raw material minus 17,500. And I think we're done with consumption of raw material. 5,25,000 minus 17 lakh 50, sorry, plus 17 lakh 50 minus 17,500 gives us 22 lakh 57,500. Then we have capital of 3 lakh 50, which will come in balance sheet liability side. Let me write capital 3 lakh 50,000 in our column. We'll have bills payable of 80,000, 84,000 in the balance sheet liability side. I'll write here bills payable of 84,000. Then we have long-term loan 7 lakh. This is also a liability, balance sheet liability side, long-term loan 7 lakh. Then we have provision for bad debts. This is existing provision of 7,000. On this, we might have to create additional provision. So this has to be adjusted. Now I'll keep this on hold for now. Let's remember that the existing provision is 7. Later we'll come across some percentage of loan, some percentage of provision that needs to be created. So we'll compute that percentage on our data. Identify whether the provision that we have is in excess or shortage. If it is in shortage, we'll create the excess provision that's supposed to be that is required. If it is in excess, we'll write off. So for now, I'm not writing that provision anyway. I've circled it and I'll wait to come across the percentage. Then we have sales of 29 lakh 75. This is finished goods sold. I'll write this in my trading or P&L account credit side. I'll write here sales 29 lakh 75,000. I'll deduct 35,000 towards sales return and then I'll arrive at net sales as 29 lakh 40,000. And then we have bank overdraft of 80,500. This I'll write in the balance sheet as a liability. Bank overdraft 80,500 rupees. That's it. We're done with trial balance. Let's now head on to adjustments. The first adjustment that we have is stock of finished goods at the end of the year was 3 lakh 50. It should come in two places. One, in the trading account, I'll write on the credit side because it is finished goods stock. Second place is I would write this in the balance sheet asset side. Come on, let me write 3 lakh 50 here. I'll write here stock of finished goods 3 lakh 50. Balance sheet asset side. Now come down to trading account. In the trading account on the credit, I'll write by closing stock 3 lakh 50,000. Great. Then let's go to provision. Provision needs to be maintained at 5%. Come on, let's find out provision at 5%. We have debtors in the balance sheet. I will write less provision for bad debts at 5% of 1 lakh 40,000, which comes down to 7,000. How much is the existing provision that we have? The existing provision that we have is exactly 7,000. So the provision needs to be maintained at 7,000 and provision is available at 7,000. See, 7,000 of provision is already there in trial balance. And they're saying provision is to be maintained at 5%. So there is no need to create additional provision. What we have is what we need. Provision is available at 7,000. Provision was required at 7,000. That is 5%. We have the exact provision. No provision to be created. Nothing will come in P&L because there is no provision expense. However, 1 lakh 40,000 debtors pay, 7,000 provision is there. The closing balance will be 1 lakh 33,000. Done. So then we have depreciation on building 3,500 and machinery 10,500. Let us depreciate, but let's write here. We don't have to compute depreciation, they have given straight. On the building, it is how much? On the land and building, depreciation is 3,500. I'll deduct that to write 3 lakh 46,500 in the outer column. And on machinery, it is 10,500. I'll write less depreciation 10,500. That will be 94,500. This 10,500 and 3,500 should come in my P&L debit side. So let me do that. In my P&L account debit side, I'll write to depreciation on building. To depreciation on building. How much is that? That's 3,500. And I'll also write depreciation on my, what do you say? Machinery. Depreciation on machinery, the extent of 10,500. Depreciation on machinery at 10,000. Depreciation on machinery. How much is that? 10,500. Done. We have the depreciation entry also ready. Then after that we have accrued commission of 43,750. This commission is due to be paid but not paid. So it will be expense as well as liability. So wherever I've written commission here, I'll add here accrued and write 43,750. Total commission becoming 61,250. And this 43,750 is outstanding commission expense liability. I'll write in my balance sheet as accrued commission 43,750 rupees. Then we have interest as accrued on investments 52,500. This is not received but accrued. So this would be my income. I'll leave little space for gross profit here and then write interest on investments 52,500. This is income in P&L and this will become asset in balance sheet. On the balance sheet asset side, I'll write accrued interest on investments 52,500 rupees. Great. Then we have salary outstanding is 7,000. Because salary outstanding is 7,000, to my salary paid here, I'll add outstanding 7,000 and total comes to 77,000. And this 7,000 of outstanding salary is our liability. In the balance sheet liability side, I'll write outstanding salary is 7,000. Then we have prepaid interest 5,250. So out of the interest that I have paid 24,500, 5,250 is to be deducted because it is prepaid and it belongs to subsequent period. I'll write less prepaid 5,250, balance coming down to 19,250. And this 5,250 because it is prepaid for the subsequent period, it is asset. So I'll write in balance sheet asset side prepaid interest 5,250. Have a look here, prepaid interest 5,250. Fantastic. That's it, guys. All the items are over. Now all that we need to do is just close these lectures. Come on, patafat. Manufacturing account mein everything else is written. So there is no closing stock of items there. There is no closing stock of work in progress. So all that we are left with is what? Writing down our cost of production. But before I go ahead, one small realization. This depreciation on machinery, whatever we wrote, instead of writing it here in our P&L account, we can write it in manufacturing account because machinery is used in manufacturing. The depreciation on that will be direct expense in production. So I'll write it in here. So depreciation on machinery 10,500. Now I'm going to do the total year 28 lakh 28,000. 28 lakh 28,000 will become my cost of production, and this is transferred to trading account. Usually in trading account debit side we write purchases. This is written in the place of purchases. So instead of purchases we write trading account. Sorry, manufacturing account, because this is the cost of production. So here I'll write to cost of production exact same 28 lakh 28,000. We have no other item coming up. So let's quickly find the total here. 29 lakh 40 plus 3 lakh 50 is 32 lakh 90. Here again I'll write 32 lakh 90, and I have my balancing figure gross profit at 1 lakh 99,500. This 1 lakh 99,500 will be brought down here on the credit side as gross profit, and this gross profit and this interest on investments I will total it up to arrive at 2,52,500, and I'll write the same in here to find my net profit. How much is my net profit? I think it's going to be net loss. The debit total is 2,55,500. Oh, sorry, net, yeah, net loss, that is 3,500. Net loss carried on is 3,500. This net loss of 3,500 needs to be deducted from our capital. So alongside with capital rate less net loss, how much? 3,500. Done. Now do 3 lakh 50 minus 70 minus 3,500 will arrive at 2 lakh 76,500 rupees. This is our capital. And then we have a lot of other liabilities. Shall we quickly see the total of the balance sheet? Does it tally? 13 lakh 66,750 on the liability side and 13 lakh 66,750 on the asset side, and this is our balance sheet tallying, and I hope you people understood. And this brings us to the end of this 20-mark question from the chapter of final accounts. This is indeed a lengthy one, but not an impossible question to do considering the fact that all the adjustments are easy. Just that the students would not have got enough practice on manufacturing account is the only reason why you should skip this problem. If not, if it was me who was writing exam, I would tell definitely this is a good question. I would definitely go ahead and solve this, considering for a fact that I am not worried about too many sub questions. One single problem, 20 marks, and you get it right, you get entire 20. So there is no two questions, three questions splitting up, which will take more time. I always personally feel like one question of 20 marks is more easier to be done and more quicker than two questions of 10 marks each. That's my personal thought of opinion. I hope people who had written this exam had aced this particular problem. And one thing that I'm really happy about is the fact that few of the science students whom I had taught in the batch went down to solve this final accounts problem, and they told that they could finish this 20 marks problem in about 30-35 minutes. That's really fantastic. And that makes me feel very, very happy for the fact that someone who didn't even know debit and credit, walking down to the commerce field, taking up CA foundation, learning from whose father what is debit, when to credit, definition of asset, to tallying a final accounts balance sheet, all in the span of about 3-4 months, and that's something mesmerizing, guys. So that's something that makes me happy as well. We have still the sixth question left, which is about what to say, journal entries for the purpose of issue of shares, as well as the last sub question about petty cash book. Let's do both of these in the next video. I don't want to keep the video very long, so see you in part 4, the last part for this series of videos on CA Foundation June 2022 paper discussion. Till then, remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun, it's all good. The day you guys either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. And very soon I'll be coming up with RTP for November 2022 examination of CA Foundation, which is going to be held in December, and quite a lot of videos on mock test paper discussion and lot more. So hoping to see you all there. Till then, tata, bye bye, take care, and as I usually say, get lost.